Good afternoon, everyone. Thanks for joining today's webinar, Financial Wellbeing Basics, Managing Student Debt, Retirement, and Investment Planning. I'm Ann Petros. I'm a member of the Young Lawyers Division of the Virginia Bar Association, and I work as Vice President of Policy Engagement and Credit Union Operations at America's Credit Unions in Washington, D.C. Today, I am joined by two experts, Derek Brainard, who's Senior Director of Financial Education at AccessLex Institute, and Anthony Williams, Director of Growth and Development at Northwestern Mutual. So today we will discuss everything you need to know about financial well-being basics. So budgeting, credit and debt management, as well as some more, sophisticated money management tools, investment planning, retirement planning, all of that good stuff will be covered and more. So we will first go through some of the details on those topics and then have a brief discussion and open it up for Q&A. And as you can see in the chat, please send in your questions using the chat function throughout the program. We may be able to answer those questions as we go through. If not, we will answer questions at the end of our presentation. So without further ado, Derek, please take it away.
Thank you, Anne. And it's a pleasure to be here with you all. Pleasure to be here speaking with Anthony. Thanks to the Virginia Bar Association for having me. And yeah, just an honor to be able to share some of this information with you all as we kick off this conversation about such a always important topic, which is managing your money in a way that gives you a sense of well-being and a subjective sense of well-being, as they say in the behavioral finance world, where you feel like you're on the right track, right? We know that statistically, and it's backed by so many studies that debt can be overwhelming. It can lead to mental health issues, anxiety. It can absolutely delay life decisions with regard to, starting or growing a family, buying a house. A lot of folks, and as some of our surveys with the ABA have shown, actually make different career decisions than they otherwise would have because of their debt load from law school, and not just from law school, but just across the board. We see consumer debt is back on the rise, and certainly with inflation and affordability being a key issue nowadays, people are feeling that squeeze on the budget. So, the goal for today's session is really just to give you some things to think about. I'm going to talk to you for a few minutes about financial well-being basics, and particularly with a lens towards student loans. A lot of the work that we do at AccessLex Institute, as the largest nonprofit that works with law students in the country, is we have a real focus, a sharp focus on financial education and capability. And so we do get to work with thousands of law students each year, and young lawyers, new lawyers, and working lawyers on all the issues we're going to be talking about today. So a lot of what I'm telling you is just from my experience, especially recently with folks via our coaching service. And our coaching service, I just want to throw it out to you all as an offering, and it is free, and it is available to anybody on the line here that wants to use it. accesslex.org/accessconnects is where you could schedule a free coaching call with us to ask any questions, follow up on any particulars from this conversation that you don't want to get into on in the group setting. Okay, so with that, let's think a little bit about basic financial management. We tend to approach it from a building block perspective, although some of these things work simultaneously. But if we think about it as a pyramid or as levels of a house, we like to think as that first level is cash flow. How are you managing your cash flow? Where's the cash coming from? How are you optimizing your cash flow with regard to tax strategy, right? And then from there, and how much of your cash is going towards debt? How can we free up some of that cash flow, right? So that we have the ability to not only to live, but also to service the rest of our financial wellness picture, which at the next level I would call something like protection. What are you doing for your insurance coverages? Where's your insurance safety nets? What does your emergency fund look like? How liquid are you? How solvent are you? All these are all the buzzwords, right? Do you have a basic emergency fund and a savings account at the bank? That's what it comes down to. And do you have the appropriate insurance coverages in the right amounts? If you're feeling good there and you got the cash flow going to where you have a discretionary surplus, we get to move up the pyramid to wealth building, right? We think about investing. I know Anthony's going to talk to you about some basics there. We think about just collecting assets, and that can look like real estate, things that go up in value or hold their value very well. It could look like real estate. It could look like your own business. Absolutely counts your 401k, your 403b in level three. And then finally, I think about legacy. How are we protecting that wealth? How are we using the wealth strategically so that we can live on it for the duration of our lives, but also how are we protecting it for the future generations? So, financial well-being, of course, changes, right? How we define our guidepost, our marker for financial well-being tends to change over time through a life course. As we age, as we mature, as we take on more responsibilities, as we increase our expenses and our income when we hit our peak earning years. So don't feel like it's a stagnant thing. It does tend to, your focus tends to change, but some of those items tend to be a through line throughout life. And that's where having a solid financial plan and using a budget. The one constant throughout that whole thing is the good old trusty budget, right? Is figuring out how am I managing that cash flow? Where are my expenses going? So one thing I want to share with you um, as we transition to how to manage that cash flow for your expenses and for debt. One thing I want to share with you is a tool that we have created for our law schools users that you absolutely might find some value in. And this is a budget template, and it is quite literally an Excel workbook that you can download and customize however you see fit. And I think you all can see that. Anthony, can you give me a thumbs up if you can see that? Okay, I'm sharing my screen
I'm
successfully.
good. I
All
got
right.
it. You're good.
Cool. So in this workbook, which they will send out after the webinar, one of the things that we do, and this isn't anything extremely new, right? This is a budget, right? But the way this is sort of a high level snapshot of a year's income. You have to have your inputs, and these are things that obviously are dictated by your salary, where you're working, what market you're in, and the type of work that you're doing. There are some pre-populated fields here with big law. You can choose from the drop down if you want to pre-populate your income, but most of you, if you're working right now, maybe you want to enter your income manually. And if you do that, you just pop down here to the projected gross income, enter it right in there. And if I were to enter in, let's just say $90,000 in there, only because that's the national median for law jobs across all types. If I were to enter $90,000 in there, it's going to run a couple things for me. And Anthony will touch on some of these things in greater detail. But again, this is sort of a high level intro to some of these concepts. So nobody's going to be a tax expert, right? Or an investment expert or a student loan expert after this. But again, planting seeds. How much of that money are you putting towards your pre-tax retirement plan contributions? Are you trying to max that thing out for the year or not? And maybe you're not that high yet. Maybe you're down more to five. Maybe you're putting money in a health savings account. Maybe your tax filing status will absolutely. Let's say you're married filing jointly. So where does that leave you? It runs through your tax brackets and it gives you your take-home pay after state and income tax, FICA, all that good stuff comes out. You can see your gross income is 90, but your take-home pay is around 64.5. So this is just again, this is important. Why? You have to get to that take-home pay to figure out the cash flow, because that's what you plug into your budget to do stuff with, right? But what did we already do? We already set aside some for retirement, which is kind of nice. And we already, in this example, withheld for our taxes. When you do that tab, it'll pop you right over here. It pops your monthly take-home pay. So this is for if you've never done a budget, it's kind of a nice way to start. But even if you have, try it out and see if it's useful, see if it's something you want to integrate into your own budgeting platform, plan, app, spreadsheet, whatever. I find Excel is still the most popular budgeting tool out there. And then it runs you through your expenses. So just make sure that you are being intentional and proactive about these things, running through your saving, investing. People like to say pay yourself first, right? That's something you hear a lot. This will pull over your investing piece right automatically into this spreadsheet. And then your student loan payments, which we'll talk about more in just a sec. But beyond that, your regular living expenses, these are your staples, the big things that are going to take the things that are necessary for survival, but also for thriving in your recreational items. So then you just got to figure out at the bottom here, okay, I got this much coming in, I got that much going out. Do I have a surplus or deficit? The surplus is obviously the aspiration because in a surplus situation, you can do things like pay down debt more quickly, pay off consumer debt, which sets you up nicely for your wealth building level. Okay. So that's like a super high level intro to sort of how we approach financial. And then within there, you fill your knowledge gaps, right? But the budget is the practical cornerstone that fuels the systems. Okay, so let's zoom in to student loans. That's one of the things that we talk with so many students and graduates about. Obviously, it's a hot topic. What's going on in the student loan world? Let me share a couple quick updates about the policies going on with the student loans because I feel like it's just such a tremendously important part of what's going on in our world, right? So let me get to where I can share this. Okay, and you should see my slides, right? And we're going to do that. Good old. Cool. Excellent. So, the One Big Beautiful Bill Act, more recently sort of called the Working Families Tax Cuts Act by Congress, was signed into law in July 2025. This made a lot of changes. If you've already graduated from law school, which I know many of you here probably have, uh, the borrowing side of it probably isn't as it doesn't have as big of an impact on you, but just so you know, they did change the borrowing. They basically got rid of the grad plus loans for new law students, which as you probably well know is a huge resource for attending a professional school is the grad plus loan. Anything above what you would have to take in the unsubsidized direct federal loan would have to be in grad plus. Many of you probably did that. They're doing away with the grad plus for next year's starting class, and instead they are upping the limit for the unsubsidized loan to $50,000 a year for law students and professional students. They're also introducing a program cap of $200,000 for a program. And additionally, they are introducing a lifetime maximum aggregate cap of $257,500. So these caps are going to have a very practical effect on folks because we know the majority of law programs across the country are more expensive than $50,000 a year. So practically speaking, law students are limited to $150,000 for their program, and that does include previous balances that haven't been repaid yet. And so if they need more than that, they likely have to turn to private loans. So you're going to see a large group of students, a large group of law school population having to turn to those products over the next few years, and that's going to have an impact on their career decisions, their financial game plan, their cash flow certainly, because we know, and I've already mentioned these numbers, just going to show them here for posterity. That's going to have a big impact because if they're turning to private loans are really different from federal loans, as you probably know, right? Federal loans have income-driven repayment plan option. They have public service loan forgiveness eligibility. Private loans do not, okay? Private loans are very credit-based, whereas federal direct unsubsidized loans are not. So if you're here and you went to law school and already graduated and you're practicing, etc., you likely took mostly unsubsidized direct federal loans and Grad Plus. So all of those loans are eligible for income-driven repayment. They still are. That's the good news. If you refinance them to a private loan, they are not, and you can't go back. So just make sure that you know what flexibilities you're giving up if you move to a private loan for potentially a lower interest rate, say if you have good credit. Resources I'm going to share with you. We built this recently after the bill was passed to help folks look for private loan options if that's something that they're going to need to lean on. It's the AccessLex Private Loan Exchange. If you know anybody considering uh, law school and thinking they're going to need this, then absolutely you can direct them here. And that's accesslex.org/PLE for private loan exchange. It's just a directory, objective directory of the major lenders and state-based lenders in the country. Uh, for you, from a practical impact standpoint, what you're going to see if you're in repayment already on your student loans, say your federal loans, there are plans that are being phased out in July 1st, 2028, including the pay-as-you-earn plan, the income contingent repayment plan, and of course the SAVE plan, which is going to be gone long before that. Those plans are all going away. The two plans that are sticking around is the currently existing income-based repayment plan and the new repayment assistance plan. That's going to be if you've already graduated and are not taking any new loans after July 1st, 2026, those are going to be your two IDR options. Okay. For new graduates, for folks taking loans after July 1st, 2026, they're also moving them to a new standard fixed tier plan that just pegs your default term to the amount of debt that you have. So for whereas most of you, if you graduated already, if you didn't do anything, they probably threw you in a 10-year standard fixed payment plan. Okay. For those who are taking loans after July 1st, 2026, their standard, if they have more than $100,000 in loans, in federal loans, they would put them in a 25-year plan by default. So that is changing, or they can opt into the income-driven repayment plan side with the new RAP plan. This is how they would set the payments under that plan. So if you are in the pay-as-you-earn plan, for example, or save forbearance, which many folks are trying to figure out what they have to do next, you likely can choose between either the income-based repayment plan or this new RAP plan when it comes out. It should be out around July. Okay. Um, the SAVE plan was struck down and is being eliminated altogether. So the SAVE plan came into effect on the Biden administration, and it was immediately sort of and millions of people went into it, unfortunately, right? Because then it was immediately paused, and there was a legal injunction against it recently that it was decided that it's going to go away. So everyone sitting in this save forbearance for the past however many months/years have to move to either income-based repayment or this new RAP plan when it comes out. The RAP plan and the income-based repayment plan are still both income-driven repayment plans that set your payments based on your income. So that's good. They're both still eligible for public service loan forgiveness. So that's good. They set your payments a little bit differently. The RAP plan sets them as a percentage of your AGI, as you can see here. The income-based repayment plan ignores a percentage of federal poverty guideline and then sets your payments based on that. It's the remaining amount, which they call your discretionary income. So sometimes that payment is lower, sometimes it's higher. It really depends on where you're at. Uh, if you're not getting PSLF, Public Service Loan Forgiveness, at 10-year mark, the RAP plan has a 30-year maximum term. So if you have anything left at the end of 30 years, it is forgiven at that point, but taxable. The IBR plan, the income-based repayment plan, has usually a 20-year. The older one is 25, but 20 to 25-year term. So you're in debt for a less amount of time on those plans. So that's where they can overall be cheaper regardless. In the beginning, the RAP plan does have one more feature, which is if it sets your payment lower than the amount of interest that your loans are accruing, it actually waives any unpaid monthly interest and does not accrue it. So that's appealing for somebody in the beginning who doesn't want their loans to get bigger. But remember, if you stay in it for the full 30 years, you are still probably paying more out of pocket. Okay. So just throwing up this example here for your use slash reference again for posterity. If you were to look at somebody that had 150K in debt, federal loans, and then 60,000 in private, you can see how the payments play out in the different income tiers, 75, 100, and $125,000. And a big thing on the cash flow side that we talked about is this DTI ratio, how much of your income is going towards your student loan payments. We try to keep that as low as possible. Of course, once it gets up over 20, it starts to become a little bit of an issue. When you start to account for your other debt payments, you try to keep that debt to income ratio as low as you can for purposes of qualifying for a mortgage if that's something that's on your radar. Okay. Okay, so before I turn it over to Anthony, just a couple resources to share. This is our Student Aid Policy and Action Center, accesslex.org/SAPAC, where if you want to keep up with all the latest on that implementation of the bill. I already shared the Access Connects coaching line. If you have specific questions about anything I covered here today, please feel free to schedule a call. It is free. So we're totally happy to touch base with you. Okay? Okay, with that, I'm going to turn it on over to Anthony to sort of talk about those next layers of the pyramid.
Derek, it's so crazy how vast the financial planning space is because you're a certified financial planner. I'm a certified financial planner, but I know you're specializing in the student loan space, right? And so I learned a ton of different things, and I use student loan experts to help my clients really figure these things out because, like you mentioned before, the type of payment plan that you're in can really impact the house buying decision, right? The education decision, and and can you guys hear me?
Yes.
Okay, cool. My computer's switching me back to the. It's fine. I'm gonna have to do it here on the phone. But Ann, do you have my? Are you able to put up the 6 areas of plan that I sent over to you?
Sure, I can share that, or you're welcome to pop it up on yours, but give me just a moment.
Yeah, and I'll just talk through it, right? So I think first things first, that I hear from a lot of lawyers, it's Anthony. What is financial planning? What does that mean? And I remember a couple weeks ago, I told someone, send me your financial plan, and they sent me an investment statement. I was like, okay, well, send me your financial plan again, and they sent me an insurance policy, right? And Derek, as you know, as being certified financial planners, we know this financial plan encompasses a lot of different things, right? And I think the area that you focused on a little bit in the beginning was financial positioning. And financial positioning, it's really just understanding where are you in relation to your goals. And the first thing we tell our clients, or we kind of talk to our clients, is what is your North Star, right? Because if you identify your North Star, it helps you make decisions much easier. And so let's say if I'm talking to someone in big law, do you want to make partner, right? Do you want to exit in a couple of years? If you want to make partner, well, what does that bind look like? How much you need to be investing? If you want to exit, well, does it make sense for us to accelerate the student loan pay down, right? Or if you're someone that's working in the public sector, are you qualifying for the right loan forgiveness program? What does that look like? Do you have the right payment plan you're in, and are you making sure you're keeping track of your payments? Because, and maybe Derek, you probably know the data on this, but I think a couple of years ago they released an article where they said that it was like over 90% of student loan PSLF applicants got denied because they're in the wrong payment program, right? And so that's positioning. And so I always tell people, think about your North Star, and for us, that is retirement date. That is when do you see yourself wanting to retire? Is that age 60, 65, 50, 55? What does that look like? And then when I go deeper into positioning, then we go into cash management. Cash management comes to budgeting, right? What does your cash flow look like? And Derek, that sheet that you had is golden. I'm gonna need me a copy of that. So you know that sheet right there is golden because it really shows you future projections. The second piece we talked about is debt management. And when I tell clients, when we look at debt, the first thing to understand is what is your interest rate? What is the monthly outflow for that specific debt? And they can figure out how to come with a proper strategy. The next thing that you also want to think about is what is your net worth? How much do you own? What do you own, such as assets, property values, and how much do you owe? That is the true, I guess, report card you can give to yourself as you tend to scale your wealth over time. So that's positioning. And so financial planning encompasses all the areas. The next area we want to talk about is protection planning. Now, with protection planning, what are we protecting? And so I firmly believe that your most important asset is your ability to earn generated income. Because if you took on all this debt to go into to get your law degree, well, your earning potential is going to be a lot more than someone else that didn't. And so you have to make sure that if you can't practice law anymore, what's going to be plan B? And some of those plan Bs can be one, disability income insurance. Okay. And you want to make sure if you're looking at disability income insurance, you want to ensure that the plan is something called a true own occupation plan. It's a plan where if you cannot practice law anymore, but you can go work at a different occupation, you still want to be able to receive your income from that specific policy. All right. Some common things people tell me, they say, Anthony, I have something through my job. People don't realize the plan through your job usually covers 50 to 60%. And there's limitation on the plan. Usually, if you make above, if you have a group plan through your employer, there we go, perfect. If you have a group plan through your employer, let me switch over here. If you have a group plan through your employer, they're only going to cover up to maybe $10,000, $15,000 per month. Okay, and so always supplement what your employer doesn't cover. And so if you're here taking notes, I want you to take your income, or if you have a calculator, take your income divided by 4%. It's called the 4% rule, but it helps you to understand the total value of earning potential that you'll make over a lifetime, right? That's your most important asset. So that's disability income. The next piece, when it comes to protection planning, life insurance planning. You want to plan for the worst case scenarios. For the sake of today's presentation, I'm not going to get into what type. Is it a whole life, a VUL, IUL? There's so many types of life insurance products out there. What really matters is the right amount. If something were to happen to you, are your loved ones going to be okay? And so when you think about what's the right amount, usually if you're single, no kids, we look at 7 to 10 times income, because maybe you have someone you're supporting that's out, that's maybe a parent or an aunt and uncle, or maybe you want to lock in your insurance rates. The next piece is if you're married and have children, 10 to 25 times earnings when it comes to life insurance coverage. Again, I don't care what type, we care about the right amount. The next piece you want to think through as well when it comes to protection planning that's relevant to everyone here would be an umbrella liability policy, right? And making sure that, let's say if you do own a home, you're having a party, and someone decides to slip and fall and they hurt themselves, they cannot come after your personal assets. That's above and beyond your homeowner's insurance policy or even your auto policy. So that's protection. Next piece we want to get into is investment planning. Now, rule of thumb when it comes to investing, you want to own stocks. So if we're taking notes again, stocks, you're an owner of a company. Bonds, you're a loaner. Stocks, you're an owner. Bonds, you're a loaner. Cash, you're just someone that has cash in the account and that your money is not working. For a majority of your career, you want to be mostly an owner of companies, because since 1926, stocks alone averaged 10% return. Bonds, 7% return. Cash, around 3%. Now, that is before inflation, and that is before taxes. When you apply inflation and taxes to these numbers, they're even lower. And so when I think about in today's world, people are living much longer. You need your money to work harder, longer for you. And so it's now more important than ever to be an investor, because the longer you wait to invest, the less time we have to have the money compound. Another fun rule, another nice number I like to use is called the Rule 72. Very simplified math where you take 72 divided by a rate of return you might receive in a portfolio. So let's say you take 72 divided by 10. That's good. That means that your money is going to be doubling every 7.2 years. as an example. And so if we can be an owner longer term, it helps us get towards our goals, whether that goal is to retire sooner, whether that goal is to send your kids to school, whether that goal is to have a buy a house, buy a car, whatever you want. You want to make sure your money's making money for you. Then we have tax planning. Okay. Now, from a tax planning perspective, I'm not a CPA. I'm a certified financial planner. However, a certified financial planner shall be identify how can be more tax aware within your financial planning. And so one thing can be tax deferral, like how is your money growing over time? Is it going to be in a tax, let's say a 401k that grows each year without tax? Or can that be in a Roth IRA where that's an account you put money into and it grows without tax and you can pull out tax free? One of the common mistakes I see people make is that they say, Anthony, I made too much money to put into a Roth IRA. They don't do anything. However, people fail to realize that sometimes based upon your employer, you might have a Roth option and you can still put money in that account. And so, my philosophy is that I don't have a crystal ball, but I do think that based upon how much the government owes on debt and how things are in the world, they need to tax people more to pay off these liabilities. And the people that are going to come after are high income earners or people that have the potential to make a lot of income. So we have to focus on tax efficiency, which is Roth IRAs, Roth 401ks. All right. And then the other tax planning piece that I want to share with everyone here is something called tax location. Okay. Tax location in our world is simply where do we place specific assets? So let's say, for example, if we have someone that has a high dividend paying stock, as an example, let's say if they had Coca-Cola or something like that. We want to make sure that these assets that you have, they're paying you out income. We want to put those in tax sheltered accounts. So maybe we hold that in a Roth IRA, and maybe something that's more growth oriented, maybe some type of mutual fund or some type of growth tech fund or whatever fund that is. We keep that in a non-qualified investment account that we can continue to take money out and also not going to give us too much taxable income throughout a specific year. Right. So that's called tax location. Then we have retirement planning. I mentioned the 4% rule earlier. Again, very basic math. The 4% rule is, again, very simple. But let's say you're sitting down here trying to figure out what is my retirement number. If I want to retire by a specific age, well, how much do you want per month? Do you want $5,000 a month? Do you want $10,000 a month? Do you need $20,000 a month? What I want you all to simply do here is take your calculator. Let's say $10,000 a month. That's $120,000 a year. Divide that by 4%. And that could be the rough number that we have to shoot for. Again, very oversimplification, but I can help you figure out what is my retirement number that I'm shooting for. Because I tell clients all the time, our job as financial planners is to get you to retirement, in my opinion. However, so many things are going to happen between now and then. Newborns, new jobs, new houses, investment property, business opportunity. And we want to make sure that we always run a plan to understand the impact of those decisions rather than continue to make these things happen and not reviewing if we're on track to the North Star. All right. And last but not least, estate planning. When I think about the basics of estate planning, we want to ensure that whatever you work so hard to build, we can transfer those assets to the people at the right time without any friction. So thinking about healthcare proxies, thinking about power of attorneys, thinking about wills, thinking about trusts, so on and so forth. And so this process can be overwhelming. However, we tell clients it all starts with the positioning. It all starts with the cash flow. Because as Derek mentioned earlier, once we understand how much money goes to retirement, how much money can go towards student loan debt, now we know how much we're really working with. All right. And so these are the 6 areas of financial planning that you want to make sure you're addressing. And, I've been in practice for 12 years now at this point. And I can tell you this, the clients that make the most result, that get the most results, that have the bigger accounts, that have the higher returns are the ones that stick to the financial planning process. And so I just challenge everyone here on today's call to, one, review your financial plan. If you don't have one, think about, what you want to accomplish in the future. Think about what's your North Star, what's your 10-year vision, your 5-year, your 3-year. Just think about it. Then you leverage Derek's budget sheet then reach out to a qualified professional that can help you think through these things and get this plan in motion, get this plan in action. And so, I can riff all day and about this stuff, but I like to take a pause here. I'm not, I'm not have to switch to my phone, but I'm not sure how any questions here. But love to, we can continue and shift over to the next segment.
All right. Thank you, Anthony and Derek. Amazing information, so much to take in. And I have a few questions for you all. And at this time, please continue to share your questions in the chat. I know that was a lot of information to digest, but any questions at all about financial planning, retirement planning, student loans, please send them our way. All right. Derek, I'd like to start with you. And that budget planning tool that you shared, really, really fantastic. I probably need to be better about using something like that on a monthly basis and tracking exactly what's coming in, what's going out, how I'm, divvying up my investments and retirement planning. Sometimes it's easy to just kind of put things on autopilot and, or do it sporadically versus like a really methodical approach. There are a lot of tools that are available online or like through your financial institution, for example, that like pull your monthly expenses, kind of give you a breakdown of what you're spending versus what you're bringing in. Can some of that be helpful in supplementing your monthly budgeting and financial planning?
I think, yeah, a good question because we are obviously seeing an accelerated like technological integration in terms of how we manage money, interact with money, and at all levels, like absolutely at all levels. So you see a lot of banking being influenced by, AI agents and or third-party aggregators where you're connecting your accounts all into one hub, like at your financial brokerage firm dashboard, where you're like connecting via Plaid all of your accounts so you can see them all in one place, this kind of thing. And so I think those tools and those devices and methods, they serve a purpose for a lot of people, and a lot of the times it comes down to convenience. So is it worth it? It absolutely can be, but at the end of the day, you just have to go back to your own question of, is this making my life easier? Is this a more efficient way to do this? And if I'm paying for this thing where it's like importing my transactions, for example, into a budgeting app, and then I have to like assign the category, well, is it worth the 10, $20 a month for this app, or is this something I would be doing otherwise in Excel? So I guess my thoughts there is it can absolutely help some people who are more inclined to use those things, and then others it can make life a little more complicated when they'd rather just sort of DIY it. So just because it exists doesn't mean that you are obligated to use it. I guess that's a good way to put it. But they can be very helpful, and of course we're going to see more and more of that integrated, whether we know it or not. AI is going to be integrated in all of our financial decisions, from a buying decision in the ads that we're being shown every second of our life, to how we transact at the grocery store, to how we invest with robo advising and fee-based accounts and firm, so it will be there. It's just at what level do you decide to participate is totally up to you. Yeah. Could
Yeah.
you tell that Anthony and I were fitting what's the old saying? We're fitting 5 pounds of potatoes in a 10-pound sack here today. Like we could sit we this session could be like a 13-week course, right? So
Yeah.
I hope
Yeah.
I just that's our disclaimer to just say again, like we know it's a lot, right? This is intended to be the tip of the iceberg, and but that's how I would approach that idea.
Perfect. Yeah, thank you for that. And Anthony, I have a kind of higher level question for you, and then a question that came in from the audience. So you talked about, reaching out to a qualified professional to help with the investing, financial planning, retirement planning, all of that, figuring out what works best for your situation. But there are financial planners, and then there's like financial advisors. What's the difference, and how should lawyers consider, what the fee structure for one of these professionals, factors into their choice?
Perfect. No, that's a great question. And I'm hearing that question a lot. And so a financial planner, is someone that is looking at the entire picture and they're understanding, hey, how does the tax strategy impact the retirement plan? Or how does our student loan strategy impact the ability for us to buy a home? And so planners are looking at the entire picture, while a financial advisor, it can be so let's break it down. We have the financial planner, and then you also have like the financial advisor. And then with if we can draw a picture, but if you have the financial advisor, we normally see one financial advisor, also known as an insurance advisor, where they may do some level of planning work, but it's typically to focus on insurance, life insurance, disability insurance, long-term care insurance. Not bad people, but that's their model. And then we'll have another type of financial advisor, also known as an investment advisor, where they're really just going to focus on one side, which is the investment piece. Not bad people, but they just focus on one side. Okay, and so that's how we should look at it. Financial planner covers the whole thing and can consider the whole thing. Yeah, financial advisor can focus just on insurance and in investments. Now, when you think about how to compensate, the compensation model of a financial planner, I'm going to summarize it and say there's like three. There's three compensation models, and some advisors work with all of them. Some advisors only work with one. And so your first model, you have a fee for service model. You charge a one-time financial planning fee. Okay. And you have advisors that will charge a one-time planning fee. We see planning fees range anywhere. It could be a one-time planning fee anywhere from like $1,000 to maybe 10,000 or 5,000, depending upon complexity. And that one financial planner is going to just simply get compensated for the plan. And then it'll be up to you to actually execute the financial plan. We're going to have to go find the investment pieces, the insurance pieces, the estate planning pieces, so on and so forth. Okay. Then we have advisors who do a commission-based relationship where they may do some level of financial planning, typically for free. They'll show you a plan and they receive compensation based upon implementation. And so that may be, the financial plan may require some insurance, may require some investments. And if you implement that plan with them, they're compensated in that manner, right? So buying a life insurance policy, disability insurance policy, long-term care, you pay your premiums, they receive a one-time compensation on that front. And when it comes to investment products, well, it depends upon what type of investment product you're buying. Are you buying like a loaded fund? Are you doing an AUM model, where the AUM model is really more charging a percentage off of assets? And so normally we see some advisory firms are charging 1.75%, and then probably can go from 1.5 down to 1% or sometimes 0.8%, depending upon their model. And then we have advisors that have a little bit of both, right? So what you have to really understand is, what are you looking for from a financial advisor? What's most important to you? And I believe that the industry should be strictly focused on fee for service financial planning. And then you can choose, do I want to implement this plan myself by going on Charles Schwab, leverage a robo-advisor? Do I want to go find my insurance agent? Or do I want to have a free financial plan? And then if I like the plan, then I'll buy a product, right? And so I think it should be more so fee for service, in my opinion. And in the way we operate here at Vivid, so yes, I'm with Northwestern Mutual. That's kind of the company that we partner with. But the name of my firm is Vivid Advisory. And we work primarily on a fee for service basis, right? But I don't do hourly fees. That's one thing I don't do. I have a few lawyers that I work with, and they bill me hourly. I'm like, come on, can we put all in one? I do one flat fee per clients, and then I also do renewal fees based upon someone's situation. Because the way I operate is more of like, hey, listen, you did everything you need to do. I don't really charge you a planning fee, but if you want to get a quick checkup, sure, it will help you out, right? And then the way we also do it is we like to grow with clients at the end of the day. Of course, we have clients that have millions, etc. But I started with clients when they have $0, right? We had some set up, get them set up right, have the right plan, then they have the right relationship. So when they do grow, it's like, hey, we're here. We got you when you had zero, rather than kind of having this facade of, hey, we'll work with millionaires, right? We want to get you to become a millionaire. In fact, that's the most fun part of my job, is help people get from 0 to 100. It's amazing.
Yeah, that's fantastic, and I'm sure very, very rewarding. One of the questions that came into the chat is like, how do you find the right person, the right, financial planner for you? Sometimes if you just do like a Google search, results can seem a little sketchy. Like, how do you know that your investments are going to be secure and well managed?
Yeah, so I think One, an introduction via a qualified source can be helpful. And so, if you're going to a presentation of a quality organization, that could be a good point. Secondly, you can obviously do a Google search, but it's a relationship at the end of the day, and so you want to be able to find someone that you can get along. Like, can this be your friend? Like, outside of the providing the service, do you actually like this person? Or are you going to dread seeing this person, every year? Right. So I think that's second. That's the second thing. The third thing is look for a certified financial planner. Okay. And so our industry, there's about a million plus financial advisors, financial planners, and only 10% of the industry is actually board certified. They're board certified. And so Derek's a certified financial planner. I'm a certified financial planner because we think holistically and we're fiduciaries based upon our engagement with the CFP board, based upon the money management, so on and so forth. Right. Now, also, when it comes to ensuring your investments are going to be secured and managed well, you have to ask the team, what's your investment philosophy? I tend to I don't do stock picking for clients. If clients come to me, hey, Anthony, what's going to be the hot new stock that I can invest in and make a quick return? I remember how one client, she's like, Anthony, I have a couple hundred grand to play with, but I need the money by the end of the year. And I was like, no, you go gamble it, not me, right? Because I don't have my clients lose money. She's like, Anthony, well, my friend's doing day trading, and I was like, well, go give her the money. I'm not trying to lose your money, right? And so it's making sure that you have the advisor you work with has a philosophy around owning everything, not losing money, and making sure you have, like, what I tell clients, we us as planners, we want to make sure you have 100% likelihood of hitting your goal, right? What is the goal? Is that goal buying a house in 2 years? Well, we're not investing anything. If the goal is, hey, we need to retire at X specific age, well, we need to invest in this aggressive manner. And so everything is driven by the actual goal. And honestly, when you have conversations with financial planners, if they're talking a lot about you and your goals and about you and what you want to accomplish, that's a good sign. But make sure they're a certified financial planner.
Excellent. All of the information, the slides that were shared during this presentation will be shared with you after the program. That includes the budget planning tool that Derek shared at the top of the hour, as well as all of the slides from both Derek and Anthony. So you will have access to those. One of the questions that came in earlier was an interesting question about paying off credit card debt and whether to use something like a HELOC or home equity line of credit or a personal loan to pay off credit card debt at a fixed rate. Personal loan may be the better option if you don't want to have a lien on your home. But Derek, Anthony, you both talked about paying off debt. What are your thoughts on this? Derek, let's start with you.
Yeah, with debt, it's a triage, right? It's a imagine your debt's walking into a hospital, and what would the professionals look at? What checklist would they walk through first? And probably they wouldn't necessarily hop to a HELOC just because of the what you said, Ann. First, they would probably say, well, what's the most obvious solution, which in most cases is like a 0% balance transfer type transaction or a consolidation personal loan, like you said. But all you do is you have to look at the actual loan fee, the interest associated with that loan over the term. So how much is that loan going to cost you? How much are you going to pay to use that loan, basically? And then compare that to the transaction fee for the balance transfer card. And you got to make sure you're paying all that off by the end of that introductory term on the balance transfer. Otherwise, you can get burnt, right? They can retroactively charge interest in some cases, et cetera, et cetera. So those are probably the first two. Maybe then you look at other alternatives if those aren't an option. Um, and then in more of not crisis, but more in more of a serious situation, you can also turn to other sources like debt management plans, credit counseling agencies, and of course bankruptcy as a last resort. But that's sort of like the triage, right? You start with the most obvious, least burdensome, and then you got to make sure you're checking all the boxes, know what you're getting into. Remember, you're just moving debt from one place to another. You still got to pay it off and stop using it while you're doing it, that sort of thing. That's how I look at that, to the triage system.
Yeah, Derek. But I mean, listen, I'm going to echo everything you said just now. And I think for you, Anne, it's probably the personal loan is probably the right fit because you don't want to put your house up for a lien. And again, this is all personal, right? Like maybe like for me, I'm like I'd rather use a HELOC, right? Because if I have enough equity in a home, I'd rather the interest only because I have more control of my cash flow, and then I could probably accelerate specific debts. But I think the first at bat would be the 0% balance transfer. Now, the one thing that I noticed is that depending upon your credit score, you might or might not qualify. Depending upon the amount that you have on the specific credit card, you might or might not get approved for the total amount. So let's say if you have a $20,000 balance, you're looking to do a balance transfer, maybe the bank might say, "Listen, we'll give you five." Then it's like, oh, what's that going to do, right? So maybe move on to the next piece, which could be the fixed loan. But then the fixed loan, in my opinion, it's a fixed payment. I see rates can be around 12 to 15%, still lower than the actual credit card debt. And so, yeah, so many ways to slice it and dice it. But for you, and based upon your situation, if you don't want to put your house up as collateral, totally get it. So maybe 0% could be first, and then maybe the loan after the fact, and then kind of go through that triage that Derek just mentioned.
Yeah, fantastic. What are some practical tips, Derek, that you might want to share with the group here for anyone interested in refinancing their federal student loans with a private lender? Usually after X number of years, you kind of look at that 6 or 7% interest rate, and you're like, I think I could do better. Let me see if I can refinance that once you get under a certain amount where that rate is going to be lower with a private lender. What does that process look like, and when does it make sense?
Well, the process is very straightforward, right? It's a private loan, and if you have good credit and an established employment history and a debt to income ratio that's within range, you can get on these refinancing these lender websites and get approved, and sometimes same day, right? Application, and then we know a refinance is paying off the loans with a new loan, right? So here's the whenever somebody, we do talk to a lot of folks about this, especially folks that go to private firms where it's just sort of part of the culture. It's a cultural norm where like people refinance, or maybe the firm has a special deal with their associates, this sort of thing. But even then, it's okay, well, let's go through the checklist and make sure it makes sense. Because the big caveat to refinancing is if you're moving from federal to private, for the lower interest rate, understand you can't move back. So you are closing doors on the federal side in the form of income-driven repayment and public service loan forgiveness. Any other loan forgiveness associated with loans is closed. So private loans don't qualify for that, and you can't move back. So that's a big risk for making that move. So that begs a couple very basic questions. Are you thinking that at some point you might move to public service work? If so, and you're thinking you're going to leverage public service loan forgiveness, obviously you wouldn't want to refinance. Um, if you're not moving to public service work, we're looking at, okay, well, do you actually have the credit position to make this make sense where you're going to get a lower score, a lower interest rate? Um, because the best rates that are advertised are obviously for the folks in the high 700s, 800 score range. So if you don't have that or an employment history to qualify for that, doesn't make as much sense right now, right? Even if you don't do it now, you could do it in a year or two once you build that up if it's right for you. Then we say, okay, well, what's the overarching goal with the debt? Are you refinancing this debt because you want to save money on the loan overall and get out of debt as fast as humanly possible? We talk to a lot of new Big Law associates about this, and they say, well, I'm going to go to Big Law to refinance and pay off my debt in 3 years. And we're like, okay, well, this is how much you'd have to pay to do that at this rate for over 3 years. Do you have the budget, the discretionary surplus in your budget to do that? Do you have the job security and satisfaction to stick it out for 3 to 5 years, however long it is you have in mind? And do you have the discipline to actually make the extra payments, right? Life happens and you got to know yourself. So that's a list of like, you got to basically check yes to all those boxes to make it where it's okay, I think I can confidently make the leap to refinance to a private loan. And if you are checking yes to all those boxes, it can be a great option. So we don't say nay, right, to private loan refinance. We don't villainize it or anything. It's right for some people. For many people, it's not. But that's how we look at it.
Thanks for that, Derek. Question that has come through in the chat. Please continue to submit those questions. These are really great questions here. Uh, One question from Dima. We have always prioritized paying off our mortgage versus loading up on the retirement account. As kids have grown up and are now applying for college, schools look at how much is left on the mortgage versus like retirement accounts, maybe other, investment vehicles, to assess the total, financial package, eligibility for a loan, like financial capability. Is there what's the best action or best approach for loans for financing education for children and just kind of planning for that?
It's a tough thing, and my answer is going to be very simple here. Um, you can borrow money for college, but you cannot borrow money for retirement. And whenever I'm creating financial plans for clients, that's just my theme. That's the tone. And some people might say, I don't want my kids to go to graduate with any student loan debt. I totally get that. But if you're not taking care of your own self, taking care of your long term retirement picture, it's going to be a lot more pressure on your kids as they get older. Because what I'm coming across right now is a lot of my clients are somewhat in the sandwich generation right now, where they have their own kids, then they're high income earners, then they have their parents. And so now they're getting squeezed. And so when they're trying to get ahead for their families financially, it's tough. And so again, that's my perspective on it. I don't have kids right now. I'm married for what, like almost a year now. I don't have children just yet. So I can't, I don't understand, that feeling. But from a mathematical and financial planning perspective, I'm always saying, listen, let's take out the loans. Let's take out the Parent Plus loans if we really want to make this education happen. But let's make sure we take care of your retirement, because the last thing we want to do is put a lot more pressure on your kids as they start to approach their high income earning years and having their own families, so on and so forth. So, Derek, love to hear your point, and I want to hear from you, Ann, too. I don't know if you have any kids, Ann, but I'd love to hear from everybody.
I mean, so here it's a tough one because the school is driving a lot of this, right? So schools look at financial aid packages. If the school is looking at the assets of the parent to determine like the estimated family contribution, for example, a lot of times they're using like an additional application in addition to the FAFSA. They may be using something like the CSS profile. So they're looking at the assets of the parent to figure out how much does this student qualify for, in addition to what they've put on the FAFSA. And so sometimes that's driven by the school, those formulas, which is what I think this person is getting at, is like they're looking at, okay, we're paying down our house, we're not pumping that money into retirement, so it shows that we have more cash flow, so maybe we qualify for less aid. Unfortunately, there's not a lot you can do like retroactively, right, to change that in terms of how the school looks at it. Obviously, it's good to know, right, moving forward. I would work with your financial planner and your tax pro to see are there any options based on the way the school is assessing that contribution formula. That is absolutely a sort of more of a technical planning conversation that we couldn't really answer here today just because we don't know the specific formula at the school, nor do we know your asset levels. So it's a great question. But now that you know how they're assessing it, and it's it's painful because a lot of times when parents get to the age to the point where they're helping their kids pay for college, they're like, we've done everything right and we feel like we're being penalized for it. We're not getting the aid because we've been building equity in our house or we've been paying up our retirement like or we've saved in a 529. And I totally understand that frustration. Unfortunately, it's a matter of, okay, so now that we know what is the strategic practical thing that we should be doing next. So get your team together, work with that financial planner, that tax pro and the financial aid administrator at the school to figure out what is the best way that we can structure this so that we are still doing what Anthony said, which is taking care of ourselves and our future, but making sure that our kid gets the education for the least amount of debt necessary.
Right. And maybe some just kind of spitball some other ideas. Again, this isn't practical, right? Because let's say your child has a school they definitely want to go to, right? It's one of those things where, hey, maybe would it make sense for us to, look into a lower cost school, local college for a little bit, kind of build up some cash, build some savings, right? And then do that for 2 years, and then maybe work on getting some more grants, scholarships, et cetera. Then kind of go into a bigger university, right? So maybe we can't do the whole thing at the same time. Maybe you can do a little bit of both, and then maybe again we have to know how much you left in the mortgage. What's your income, what's your cash flow, and then it's like maybe you might be someone that has a pension. Through your job. So maybe you're taken care of on that front. So there's so many questions that Dirk and I are thinking about. And so definitely reach out to a team, get a plan put together so we can kind of figure it out because and it's all going to be all personalized to you. There's no like, do this, you're good. No, it's based upon you, what you want to accomplish.
Well, thank you both. Again, a wealth of information here, so much to digest. And thank you for submitting the questions, everyone that tuned in today. Really great questions. And Derek and Anthony, fantastic job running through the questions, through all the material. Thank you again.